Okay, hello everyone. Welcome to this weekend's weekly study session, which is actually being recorded on Friday. It's about 7 o'clock in the evening. I have to travel tomorrow for my daughter's birthday, so I'm recording this tonight. Should have it out momentarily after I'm finished, and I guess tomorrow or it might be Sunday that I get to do the stock work, and then I'll have the stock video out sometime no later than Sunday. I'll try to get it out tomorrow evening, but most likely it's going to be Sunday around dinner time. Let's start off by taking a look at the risk model as we do each week. Sell signal, of course, still in effect since November 22nd. This has definitely been one of the longer sell signals that we've had without an intervening buy signal, but we are on buy alert as of June 24th. So that just means that we're on alert for a buy signal and we can entertain some stocks, but risk is still, of course, high. Being on a sell signal, general market is still neutral. We did get a great rally today, but the volume just wasn't there to get a follow-through day and to show the type of accumulation that would help us move the general market to positive. Up-down volume is positive. New highs, new lows, still negative. And stock participation is neutral on the risk model and also neutral on the STEM model, which is purely stock-based. And again, we're not in that hard penny, very cautious environment or reading, if you will. At this point, we move to the cautious exposure, not the very bullish, easy dollar environment where we can get a little aggressive and things are working great, but enough where we certainly can take 25% exposure as a toe in the water. And if those positions are working, maybe move up to 50%. Any more than that, I would only recommend if you're seasoned and experienced. Certainly, you need to be doing well on those initial positions to add more positions and more exposure. So again, we're still cautious there. And we're going into the long-term wind in your face, if you will. So the long-term trend model is still, and we follow a number of long-term trend readings, if you will, and they're all negative. They're all negative. They're all sharply negative. So there's a lot of work to be done to get the long-term trend to turn around and to get that proverbial wind in your sails. So again, we may have rallies here, and it looks like we may have started a good rally here that can take us a bit here on a trading rally today, closing up over 600 points. But these are probably rallies within a bear market, and we'll still need backing and filling, and probably still more time to move sideways and carve out a reliable bottom on the major averages. Inflation, of course, is the catalyst of in recent times here, and certainly in the last few days, year over year, CPI came out 9.1%. That was above expectations and a 40-year high. So again, when we look at these inflation numbers, you can, like I said many times, you can slice and dice numbers. You know, the more you torture numbers, they'll tell you anything you want to hear. But when we take a look and we look at these numbers historically, we are at a point where we could be peaking. You know, if you take a look and you go back to 1975, when we got this distance away from the 5-year moving average, we peaked and the market bottomed, almost coincident. But then when you look at 1980, we did peak, all right, from this level. However, what happened was we came in on the inflation, but then the economy softened and we went into a bear market in stocks. Now, we've already been in a bear market. So that's why I think the market might have gotten ahead of the economics here and done a lot of discounting. And at this point, with the market down so much, I think that we would have to really have a hard recession to have big downside from here, because I think we've discounted quite a bit, especially when you look at individual stocks that discounted even prior to the market really rolling over and getting the big decline in the NASDAQ below 30%. You had a lot of stocks that were down 40, 50, some 60, 70, as much as 80%, even more, depending on the names, of course. So again, we could be peaking here. Of course, we've got signs of copper prices, lumber prices, oil now rolling over, energy stocks that were leading, used car prices, repos, used car repossessions, retail softening, inventories building up in retail. So a lot of signs that inflation beneath the surface, and that might be why, you know, the market handled this number relatively well. I mean, really well, actually. And if you go back here, and if you just go back 3 days here from today, right here, you'll see that that left little hash mark, that's the open. That's the S&P 500 opening in the morning. We gapped down on the CPI, and then ended up closing up from the open and a little above the mid of the range. So that was the first sign that, that was a pretty good of handling the news. However, next day it looked pretty ominous, and we gapped down again. And intraday we were down a good amount. However, um, we got stopped out of a couple names, but most stocks held up relatively well and stayed in those pivots. And that was a sign right there that I thought that this may be a shakeout. And everybody's worrying about us going to new lows right away on Twitter. Everybody's saying, we're going to new lows. And I was getting crucified for the tiniest bullish comment of buying some pilot positions. And sure enough, today we gap up and we have a big day up. And you probably will get a rally back maybe to the 50-day or even better here. But again, we still got to be very careful here. When we take a look and put this into perspective, we're a long distance off the highs here and a very short distance off the lows. And below the sharply declining 50-day moving average, a declining 200-day moving average. So like I said, we've got the longer term trend in our face here on the downside, and we're still in a bear market. If you look at the NASDAQ, we're a long distance away from the sell signal, November 22nd sell signal right off the highs there. We are way down by the lows, and again, in a sharp downtrend. Now, something interesting, if we go back prior to the market topping, the NASDAQ top, of course, in November, we had some pickups in inflation. If you remember, the language was that it was transitory, that it was just short-lived. It wasn't going to last. Of course, that turned out to be extremely wrong. But the Fed ended up dropping that language. Since then, you can see inflation has obviously picked up, and we know that. But going back into October, after September, going to October, you see there was a pickup in inflation, and then Powell drops the language transitory from their vernacular. And that's when the market topped almost to the day. November 30th is when Powell dropped the language, and the market topped on November 22nd, right before it. So again, quite interesting. So inflation has been driving this market, and the reason why I'm saying this is because the good response, the market holding up well to this recent inflation number, tells you that a lot has been baked into the cake here. So the question is, and this is using the 1970 bear market, are we in a point where we're near the bottom here, and we're going to bottom out, and any rallies from here are the start of a new bull market, or are we just coming off of one of the lows within a downtrend, and we have much lower to go? That's the real $64,000 question, and I think that is really going to be driven by, of course, how the interest rates affect the economy, and how if we get a recession, how deep that recession is. I think at this point there's a very good chance that we get a technical recession, that we have the multiple quarters, several quarters of negative GDP. And I think that we're probably going to fall somewhere in between here. Either we have to undercut the lows and go a little bit lower, or it's just going to take some time. And of course, I've been pointing out precedents for a couple of weeks now. I'm going to show you those in just a second here. This also agrees with historically taking a look at when you have the S&P down 15% in a quarter. Looking going forward, 1 quarter, 2 quarters, 3 quarters, 4 quarters, and up to 8 quarters, you have all positive returns except 1 quarter, which was in 08, the Great Recession. And again, that's what I'm saying, that if we have a really deep recession, yes, we may go down more, but even then, I think we would be contained probably to maybe 10%, or even if we undercut the lows here and things get out of control for a little while, maybe we have a downside of 5 or 10% below the lows, and that's where you would see just incredible amounts of bearishness, and it would get real scary. And I think that's where we could see a low if we haven't already. Now, of course, this is post World War II. This is post 1940, 1946. This starts this data. If you look at the Depression era, well, that's a different story, and I don't think we're going into depression, but that would change everything, of course. Looking at, of course, you've seen this chart for many weeks now, but again, at the levels we're down, All right. And this, what I want to point out is that non-recession says that at down 20%, you're near a low, usually within 4 or 5% or so. However, with a recession, you could go lower up to averages about 35% off the highs and take more time. I think we're maybe in between that. And that sort of is also playing out with the percentages and, what I'm seeing happening here. Maybe, we don't have a big recession, but we have that softer or softish landing. And that could lead to an undercut of the lows, which agrees with the cycle work for the NASDAQ, which would bottom in October and then a very strong uptrend. Also, if you look at the presidential cycle, the 4-year presidential cycle, that also shows a bottom in October and then a very strong uptrend. And the precedents that I've been looking at, 1962 in particular, where you do have to, you get a rally, which I think we might be in that now, and then you roll over and bearishness picks up and everybody calls for new lows, and either maybe you undercut the low or not. That's not really meaningful at this point, although an undercut of the low will certainly bring in the bears. And then from there, you're able to put in a bottom after you build that, you carve out that bottom. And that's why bottoming is a process. Depending now, just corrections in a bull market. When you're in an uptrend, you have corrections. The interest rate environment is favorable. Economy is doing well. You can come off and very quickly move right up, and you don't need to spend all that time building a big bottom. But when you're in a bear market, pretty deep bear market, you've got rates moving up, you've got inflation. This is not going to just turn around on a dime. Okay. Now, 1990 is the precedent that I think this may play out most closely to, in respects that we're going to just need time to move sideways and maybe have a shakeout somewhere on that right side where it looks like there's going to be another trip down and it's going to get scary. But stocks during that time will hold. Many of the leaders will either emerge and then pull back to their breakout levels or be basing during this time. So you've got to keep your eyes peeled and be very, very vigilant, and ready to act, and also be willing to hold some names through this if they're working. If you're seeing setups, the setups are emerging, they're breaking out, and you've got names that are working and holding. Stick to those stops. Improve your worst case scenario. If the stock moves up, move the stop up. Maybe you move to break even. Protect yourself, and you free roll. And this is your best chance of getting on an emerging leader. Here's the thing: if you're not willing to buy stocks that are acting well and look at it from the standpoint of assessing the market stock by stock, well, then you're probably never going to buy the leading stocks in a bear market, because leaders lead, and you've got to buy them when things look scary and even when the market is going to lower lows sometimes. So it's important. Now, that doesn't always work out that way. Sometimes the market bottoms first and you get a lot of stocks that set up coincident with the lows, and they don't lead that much, or they just lead the bull market. They're the first ones to go. So it doesn't have to play out like exactly like that, but you have to be open-minded and be willing to let the stocks guide you and not the market indexes, especially at this point. Now that we're down over 30% of the NASDAQ, it's time to shift over to the stocks. When you've got sentiment at these levels, where you can see you're down at levels that many of the bottoms have happened over the last 20 years, notwithstanding, or of course, with exception of the Great Recession. So again, if you have this, a real bad recession, yes, you're probably going to need to go lower. It's going to take more time, and you're probably going to need more negative sentiment because, as we know, when the interest rate environment is against you, you need more sentiment and more negative sentiment than when the interest rate environment is favorable. But again, notwithstanding that scenario, I think we've already baked in a lot of news into this cake. Now, taking a look maybe on a shorter term basis, percentage of stocks above their 50-day on the S&P 500, they came down to levels where we only had 2%. It was basically every stock was below the 50-day moving average. When you get to those levels, you're generally at a bottom, at least some type of trading bottom. If you go and you see even the COVID bottom, you came down to these levels. However, when you go back again, this is where I want to contrast the difference between strong recessionary times and inflationary times to non-recessionary times. back in '08, you had that same scenario and you rallied, but you had to make another low, and then you got the divergence. You see, you got less stocks going below their or more stocks above their 50-day moving average, and that's where you got that divergence. We might have to see that this time. We might get a lower low in the indexes, but then you start looking for those divergences and look for the stocks that are acting the best, that are holding in their pivots, holding their breakout levels, maybe pulling back to the breakout, and look for the divergence in some of these indicators that look at the internals. So the market held on bad news, and that's definitely good short term. With sentiment as bearish as it is, and stocks setting up here and breaking out and holding up relatively well on those few days that we had, those couple of days that we had where the market came in on that CPI news, I think that you've got to look at this as a trading rally and an opportunity here. Most of those breakouts held the stops. Now, the market as a whole, the indexes are definitely not out of the woods. We've got work to do here. And even if we rally, we could get a very strong rally because some of the biggest rallies happen in bear markets. So we could get a very powerful rally here. But if we ran up real fast here, I would be almost certain that, we would have to back and fill and spend more time, but it could be a great trading rally. So remember, the best names bottom first. At this point, you have to shift to a stocks first mentality. Get off the indexes. The indexes have made a big decline here. They've come off a lot. A lot of stocks have gotten murdered. All the stocks that had to top have topped. And now you've got sentiment at very pessimistic levels. Now you start looking for the leading stocks because this is where the leaders lead. I want to show you something else here real quick. Well, actually, let's just talk about, reiterate what we talked about last week. Proliferation. We want to see a proliferation of stocks and bases. We're seeing some. All right, we do see some stocks setting up, but if you just go into MarketSmith, for those of you that use MarketSmith and you run my trend templates, you'll see that there's, I don't know, 100 stocks maybe, in the confirmed stage 2 uptrend template. That's a very small amount. So, I mean, I've seen that number up at, I think, 900 during the bull market. So we need to see more stocks and uptrends, more stocks and bases, but the leading stocks are going to be the ones that you're looking for now. And that might be a small list of names. Then we want to see how stocks are coming out of those bases, if they're actually breaking out, because in a real difficult market, they don't even break out. You'll see stocks will set up in bases and they just fail. Well, you also get sucked into some breakouts and they fail shortly after. And that's what we've seen also all through 2021. A lot of breakouts failed subsequent to the breakout, and even recently in these recent trading rallies. So how are the breakouts performing? What we're trying to ascertain is whether we're seeing institutional buying or retail buying. And institutional buying is the buying that can move a stock and keep it moving. Retail buying can blip it up for a couple minutes, couple hours, but usually not even a couple days. So as I pointed out many times, the key is your stock a tennis ball or an egg? And that's what we want to gauge. So far, we're seeing some tennis ball action. All right. I wouldn't say it's super strong tennis ball action, but we're definitely seeing some tennis ball action. Let me show you what you don't want to see. And I'm going to get into this more when we talk about stocks in the next video. But just to talk about this real quick and end on a note of what we don't want to see is we don't want to see stocks turn into eggs after they break out. This is looking at Eagle Shipping. If you remember, this broke out back in May into June. And the group was real strong. This oil was acting great. Oil stocks were acting great. The shippers were one of the leading groups. And this stock came out of this base and very abruptly came right back in hard, had that big down day, could not rally. And then you got the lower lows. You started getting below the moving averages. And this is exactly what you do not want to see. This is not tennis ball action. And every lower low after that third lower low just gets more ominous. The more it's living below those moving averages and coming back into the base. Now, of course, then it breaks below the base. It gets below the 200 and it's just getting worse and worse. However, if you just ran, and I'm going back here to the third lower low, I would have started, of course, being very I would be very cautious after that first big down day right here. But if you ran Monalert on 610, which was the third day, 2 days after the big down day, you can see right here, it started picking everything up. Right on that first down day on June 8th, you had 128% increase in volume. You were closed below the 10-day, you closed below the 20-day. You're down over 11%, almost 12% on the widest spread. So right there, that's a huge flag, right? Next day, you close below the 50-day and you go under pressure. Right here, always check if you're under pressure, especially when you're buying a stock that's coming out of a base. You want it to not be under pressure. You're down another almost 5%. And then you start getting the lower lows start piling up. On the 10th, you get 3 lower lows. And now you close the week out on the largest price percentage down week, which is a big, big red flag. So you've got all these red flags, which would have, if maybe you didn't hit your stop yet, but this certainly would have told you to get prepared to get out of this stock or start trimming, start pulling back your position. So again, we'll get into more on the individual stocks coming up in the next video, which like I said, I'll try to get done as soon as possible. Again, Master Trader Program is coming up in November. We're getting closer and closer to it. And keep in mind that if you enjoy this analysis and this in-depth looking at the charts, we go over hundreds of examples and charts and everything A to Z during this. Mark Ritchie will be my co-instructor this year, so we hope to see you there. All right, let me get back to work here and try to get you this next video. I hope you have a great weekend. Bye-bye.